Excluding COVID, as I said, and the introduction of the GST, Australia's economy right now is growing at the slowest pace in 30 years. The December quarter GDP, it came in right on forecast, 0.2% for the quarter and also 1.5% through the year. Well, the modest numbers were driven especially by subdued household spending on discretionary items in particular. That belt tightening plus above inflation pay rises is reflected in higher household savings. They jumped from 1.9% to 3.2% during the quarter. It was thought they might have even gone negative. So is this December quarter GDP the bottom out of the economic cycle? Well, only time will tell, but economic indicators in the past few months suggest slower inflation and higher unemployment. These are signs that support the argument, of course, for interest rate cuts later this year. Treasurer Jim Chalmers says, given the economic circumstances, these economic numbers should be viewed as a good sign.
Even weak growth is welcome growth in the circumstances. Slow growth is still significant growth given the challenging global conditions combined with the impact of higher interest rates.
So let's bring in here one of Australia's most respected and senior market economists, Alan Oster, Chief Economist at the National Australia Bank. Alan, always good to chat to you on these days. Do you read it like the Treasurer does, that we should see good news out of these numbers?
Well, it's a bit difficult. I mean, yes, you're true that you've had negative numbers in Germany, you've had them in Japan and in the UK. I personally prefer to see stronger growth. Basically, as you were saying, consumption's very, very slow. Slowdown in particularly the construction of dwellings being offset essentially to some extent by increased spending in the public sector, and then stocks and trade sort of offsetting each other. I don't really see that the Australian economy is going to pick up momentum until halfway through this year, when you get tax cuts, you probably get extras in the budget. And then by the middle of the year, I think people will be getting much more close to the idea that Reserve Bank will cut rates, let's say, at the back end of the year.
OK, so does this take you away or change your forecast as to when the first rate cuts come from the Reserve Bank?
Not at all. We're quite confident the idea that, if household incomes in real terms are now starting to go up a little bit, then consumers may actually have the ability, if they want to actually spend a bit more. So I think, and if you looked at the increase in inflation and wages during the national accounts, they're still pretty strong. So we've got our first cut in November, and we're more than happy to stay there at this stage.
I was just going to ask you about that, because it does show real wages growth. We saw that even when the wages index came out last week. The Treasurer has been coming out and saying he welcomes and celebrates the fact that wages are going ahead of inflation right now. But what I'm worried about is the impact of those wage rises on inflation, that it keeps it a little stickier than what the Reserve Bank and maybe the government would like to see.
Well, I think that's right. And if you look at it, where are they spending? They're spending in services, and they're pulling back on anything that's discretionary. And you get that sort of breakup in the accounts. So what it's sort of saying is the worry about services inflation being stickier than normal is probably still there. So, you're going to have a situation where the Reserve will meet in a week or so's time, nothing will happen, and really you're not really going to get a good indication in the March quarter CPI until May, June, and I think that's too early. The only problem would be if unemployment started to go up faster than we expect. So we expect unemployment to keep drifting up, let's say 4.5 by the end of the year. If you can do that, unemployment stays really low, then a consumer can juggle. They can sort of get an extra job, or they can cut their spending and survive to November. But if unemployment, say, is 4.5 by the middle of the year, that's going to be an issue. So provided, and we're all sort of on the same page here, that we think unemployment will go up, but go up moderately, then you can sort of survive. And that's what I think the Australian economy will do until they get some extra income and sort of more reassurance in the back end of this year that things are going to basically improve.
The one thing the government can take out of this is that the employment, having remained fairly strong, means it's going to have significant revenues coming through its own budget. Plus, on top of that, you had net exports obviously being another significant contributor. So if the government at that time considers it needs to hand out more cost of living relief on top of the tax cuts, well, it's in a position to be able to do that.
It certainly is. And, if you look at the 12 months too, on the latest numbers that were released, you're on a surplus of about 28 billion, which is pretty high. I think the other thing that the government can look at and hope for from a political point of view is that if we're in 2025 and our forecast from the Reserve Bank is roughly right, then you've got growth back to about 2 and a bit. You've got unemployment still with a 4 in front of it. You've got essentially inflation back in target. And the cash rate, we think by the end of 25 will be around 3, which is roughly neutral in our view. So very few countries in the world will look as good as that. So if you like, short term, still got pain associated with what they've done in terms of interest rate increases and cost of living. But in the medium term, I think the outlook for Australia looks reasonably good, or certainly relative to what other countries are seeing.
Just one other thing, I did note that productivity, everybody talks about productivity and where that sits and about Australia's productivity having gone backwards, but productivity has improved again in this report. Why? And what does it tell us about our economy right now?
Well, I think you want to be very careful about productivity. Basically what happened was hours worked went down, which is not great. And so therefore you got a cyclical increase in productivity. And I think really what you should be looking at is productivity over the last 10 years. And there we're sort of averaging something like 1%. And the Reserve Bank is saying they assume that as we go forward, productivity for here might continue at around 1%. That's not a great outcome, but at least it's positive and that will help. So I wouldn't read too much into the quarterly GDP estimates of productivity in the current environment, because if you like, as the economy slows, in a big picture sense, people are cutting hours rather than cutting heads. And so that means that productivity improves in that sort of environment.
I'll tell you what, always good to have your analysis on these days, Alan Oster. Many thanks for your time.